All right. Good afternoon. Today I welcome here and I have the great pleasure to talk to Dan Roddick, the principal, founder, and a managing partner of Ely Place Partners. Hi, Dan. How are you?
Good. Thank you, Mikhail. Thanks for having me here.
Yeah, no worries. Dan, we've known each other for several years now, ever since you started Ely Place. So, what is Ely Place? What do you do? What's your day-to-day business about?
So Ely Place is a placement agent and secondary advisory firm, fundamentally. So what's that? We are an advisor to GPs, i.e. managers of private equity funds. We help them in a number of respects. So principally, we help them in raising money. So we help them go out on the road and introduce them to the likes of pension funds, insurance companies, fund of funds, and so on and so forth. And then we are paid commission for that capital that's raised. But much more than that, we assist on everything that goes on around the fundraising. So it's supporting the GP with preparing the initial documentation, writing the prospectus, getting the data room done, and assisting the GP and indeed the LP through the whole due diligence process. And then the second part of the business is the secondary advisory firm, the secondary advisory angle, which is really advising on the secondary transfers of LP interests. So once an investor has made a commitment to a fund, it may choose to sell at a later date, and therefore there's a very niche market, although much less niche these days, but there is somewhat a niche market in the buying and selling of those assets, and we intermediate on that.
All right. So basically, if I might summarize that, the work is basically being an intermediary and advisor between GPs and LPs, and at a time where they're looking to acquire stakes in the respective funds. Is that correct?
On the secondary side, exactly. That's correct.
Perfect. Well, how did you get into the placement business, into the private markets in general? Because I don't suppose that's what you study in a university, right? I mean, there is no such program such as being a placement agent, or getting to secondary advisory.
Well, so it's a somewhat niche industry, but really now compared to how it was when I started, it's grown massively. So really, I would almost say it's becoming more and more mainstream. But it was a process. It was an evolution, really. I started my career at McKinsey. I was working in the corporate finance and strategy practice. Within that, they formed a private equity advisory business because private equity was growing in size and significance. They were working with more and more private equity clients, and therefore decided to form a separate division. And I was involved in the early years of helping in that, albeit as a very junior person, and just became interested in the asset class and excited about how it was growing. Hence, then just deciding when I left McKinsey to keep going and to specialize in private equity.
Right. So what made you decide to go into that route and not into, active investment GP route, right? I mean, the obvious, dream of many people in that age and in that caliber is, to become an active manager and, to have your own fund and, to make your own name out of there, in the industry.
Well, it was, again, more of an evolution for me. I mean, keep in mind that at McKinsey, I was already working as an advisor, so advising private equity firms. And then the company which I subsequently joined, Campbell Lutyens, they were positioning themselves as advisors to private equity then, and not just a placement agent. They were really presenting themselves as consultants to private equity. And this seemed like a logical continuation for me. But also, as a young professional, it's a very difficult industry to enter, and to be a GP. It's not only highly competitive, but really requires specialization. So it tends to be one that people often do after they've got some sort of industry or finance experience to begin with. So that wasn't really ever a consideration for me.
So what has driven you towards private equity? I mean, you're, in the private equity group, McKinsey, and, you obviously get to know the industry. But what made you decide, look, this is exactly what I want to do? Even in another firm, when you joined Campbell Lutyens, you went into the same field and you were like, okay, well, this is what I like. This is what I'm going to do. This is what I'm going to dedicate my career into.
I wish I could say that there was a decision point like that, but it really wasn't the case. And if I'm really honest with myself, I think it was a combination of, firstly, just the way things turned out in McKinsey, and then I think I knew I was there for a couple of years, and although I had a great experience there and really enjoyed working with very intellectual and creative people, I think I knew that my future wasn't as a consultant, and as I say, it was more of a natural progression more than anything, and excitement about how the asset class was growing. But honestly, I mean, after that, part of it was that once I had started off in this rather niche industry as a placement agent of advising GPs, it wasn't so easy to suddenly switch careers. Not that I tried, but I just thought, well, no, I've made my bed now, so I'll sleep in it. I'd started down a certain path. I enjoyed it. It wasn't necessarily how I envisaged my career going when I started off at McKinsey, but it was a niche growing industry, and it was something I was gaining expertise in. So I thought I would stick with it.
All right. Well, you're saying that it wasn't a conscious choice, and that at the same time you're saying that you didn't get to make that decision. It was more of a progression, but at the same time, there was a conscious decision. I'm very, very curious about, because when you were working at Campbell Lutyens, for several years now, and you came from McKinsey and from very strict background, you get your training, you get your career on track, and then you decide to let it all on the side and go study music. I mean, that's a ballsy decision, if you ask me, because not many people actually take their passion and say, you know what, high grade, heavy hitting career, I'm just going to put it on the side for the time being and go do what I really, really love. So could you tell me about that a little bit?
Yeah, fine. And again, I'm not sure if there's really a sort of clear rational reason for this, but if I try and think through my thinking, look, I think first of all, when you're in your 20s and you're trying to find your own groove, you don't necessarily know at the outset what you want to do, what will ultimately make you happy, what balance you want in life. I think you perhaps often start off in your career sort of very, very ambitious, and you want to work long hours, and you really want to make it, and that's that. And then as you mature, then you come to learn that there are other things in life that you need to sort of tick all the boxes. And for me, music was always an important part of my life. I had always sung in choirs. I was in youth orchestras. I, still to an extent try and play the piano. And it was partly a social outlet for me, but also just intellectual and using a different part of my brain and a way of unwinding. At that time, while I was at Campbell Lutyens, singing was becoming a bigger, important and more important part of my life. And I really had to make a decision, because I felt that I was having to compromise everything. I felt that I was having to compromise the time available to sing, and really compromise how much I wanted to dedicate to my career. So I just thought the sensible thing to do would be simply just to take a year out, get it out of my system, and then take it from there. So that was really the thinking. And again, it wasn't an overnight decision. It was something that really sort of evolved that way.
So kind of like a sabbatical, you would put it, yeah?
Well, yeah. Because an academic year is really only 9 months, and I just thought, I'll do this. And whereas the firm I was working with were, I wouldn't say they were super understanding, but they accepted it. I enjoyed working there, and I think we were onto a good thing. So they didn't want to lose me altogether. So we came to an understanding where I would do this, continue to work part-time, and then back to where we were a few months later. That was the idea.
Okay, well, singing is also where you met your future wife. I think that you were supposed to be getting married last week, right?
Well, yeah. So that's a different story. So much later on, then I met her. Yes, through singing. So singing has led to many things, including meeting Kay, who's a conductor, and then we ended up working together, and now we're getting married. And we were indeed meant to be getting married a week or so ago. But there we are. One of the, we've had a global pandemic, and it is what it is. And we're going to be getting married next year instead.
Oh, congratulations. But singing also led you to your first entrepreneurial stunt in the industry, right? Because you, for the first time, got to work for yourself, being an advisor to one or two clients on the side, correct?
Yeah. So a couple of things then happened. I took the view that I didn't necessarily want to go straight back to my career after a year. It just went by in a flash. But also, rather fortuitously, really, first of all, I was due to do some work over the summer holidays with my old firm, and then that didn't quite align for the timing, and I found myself in a position where I needed to find extra work, and also I was having to pay for studies and so on. So there was a need really of just having to get some income. So what I ended up doing was just reaching out to potential clients that I could advise, do project management work for, and the sort of things that I was doing at Campbell Lutyens without the actual fundraising, just more general support. And that summer, when the work sort of didn't work out at Campbell Lutyens, I was able to get other work, my first real clients, and that then bit by bit led to me having my own business.
Okay, so how does one do that? You said you approached some of the clients. I mean, did you go on a list of the biggest funds and just called outreach to people like, hey, do you need some work done? Or
no. I mean, it was just word of mouth more than anything. I think I just called up a couple of people I knew in the industry, or people I'd been staying in touch with, friends really, and just saying, just asking around if they knew of anyone looking for some support over the summer, and that's how it came about. Really, I mean, I wasn't choosy at all. I just frankly needed some work in order to pay my fees, and otherwise I had a very empty summer in front of me, and it worked out. And then once I'd started with one client, then one thing led to another.
Oh, that's such a cool story. But this all led you to forming Ely Place Partners with your partner Gavin, right? So how did you, Gavin, and you meet? I mean, how did you guys decide that, let's do something of our own, because, that really makes sense. We click, and let's kick it off.
Well, with Gavin, so he and I were working together at Campbell Lutyens. And in fact, he was already there when I joined in 2003. And then he also left after me. But by complete coincidence, where I was working for my first clients, he, who had by then just left Campbell Lutyens, he was also doing some freelance advisory work, and his client was in the same building. So we would bump into each other in the lift in the mornings. So we kept in touch, and then he looked to pass some work my way, and then we spoke about collaboration. And then then fast forward a year or two, when I was then setting up the placement division for Epic, it seemed just the obvious thing to do, and ask him if he wanted to also be part of that. Because we'd already been sort of speaking together about this sort of thing, and looking to collaborate for a good year or so before then.
All right. So, well, this is 2003. I mean, that's.
Oh no, 2003. I started at Campbell Lutyens, and this
right. It's almost 20 years in the placement business itself. I mean, you must have seen some radical changes, because the private equity has grown so much and changed so much over the past decade, not talking about the past 20 years. I mean, what's the general things that you've noticed that have changed?
Well, I mean, several things. Gosh, where to start? I mean, first of all, just the size of it. I mean, it's just the growth rate has just been incredible, I think private equity has really proven itself as an asset class, and I think it's been through some tough times image-wise and so on, but I think it's really proven itself as an essential asset class for institutions, as a viable and sustainable owner of businesses, and playing an invaluable part in job creation and contributing to the economy and so on. So just the size and the growth of it, just I think proves that. It's gone through quite a journey, I think, in the way that regulation has helped shape it, and banks have sold off assets, and there was some major changes post the GFC and so on. But I think the main other change is just the sophistication of it. Mm-hmm. So now there's real expertise and very, very sort of detailed specialization. You've seen sub-asset classes in the way of technology and debt and infra and so on and so forth grow to become their own asset classes today. What I was going to say, and then as part of all of that, our role as an advisor in helping GPs and LPs navigate all of this has become more significant, and indeed the number of players in the space. I don't have the numbers at my fingertips, but just the number of LPs now is significantly higher than it was obviously at the outset when I started work.
All right. Well, you outlined on the outset the nature of your actual work, but when we talk about placement, not many people actually know what is it that you do. Can you just go into more of a detail about who is a GP, who is an LP, and what is your role in between?
So. So GP is the manager of the private equity fund. LP, limited partner, is the investor in the fund.
And LP in general, I mean the GP Sorry? And the LP, I mean in practice, in an example.
Give an example of what I didn't quite catch.
Example of a GP, an example of an LP, right? Because LPs can be sovereign funds, can be pension funds and family offices and so on and so forth, right? So who would then be the GPs, and what sort of relation do they have? Because technically both of them are investors, just in a different form, right?
Yeah. So your GP may be KKR, Apollo, CVC, Advent, to name some large ones, and then the LPs could be either funds of funds, so they're actually another layer between the fund of the GP and the end investor, and then the LPs behind that could be any pension fund. It could be a sovereign wealth fund, as you say. It could be an insurance company. It could be a family office, endowments in the US, and so on and so forth.
Okay. So what is your particular role in the ecosystem between the LPs and the GPs? I mean, it's not just like you know everybody and you introduce one to another. It's much more complicated and much more profound than that, isn't it?
Well, I think that possibly as its simplest form, it can be thought of as simply being an intermediary between GP and LP. And in the olden days, maybe that's kind of it was more of that, and you have your Rolodex and you bring investors in. But I think today, if someone wants to look up who the LPs are, then there are databases and so on. You can buy, you can look up someone's telephone number, etc. But but we see our role as being more advisors to GPs, and it's a lot of it's to do with raising money, but it's to do more generally with any funding issue. It's to do with building up their brand name, some PR work, making LPs aware of their strategy, but also it's just how they articulate that strategy. So that the GP will be an expert in investing capital in their precise area, whatever it may be. It could be private debt, it could be infrastructure, it could be the mid-market in the UK, it could be the Mittelstand in Germany, it could be some niche area of technology, it could be Series A, whatever it is. So that's their expertise. What they're not usually expert at is how to go about raising capital. For a typical GP, they do it every few years, let's say every 3 or 4 years. So it's just not something that they're experts in. So they just need support. And the fundraising process is so complex. The due diligence requirements of any given LP are so complex that it's just a huge undertaking.
It might be actually helpful if you can walk me through, the steps in the process, because it's not only that you ask for the money and somebody subscribes it, right? There are several stages which each of its set of rules, right?
Yes. So typically speaking, you would first of all, well, it starts off with the GP would usually have some sort of presentation, but there's a certain form that an LP would expect to see the information presented in. So there's a sort of an industry accepted standards that a GP wouldn't necessarily be aware of. And these are to do with how the track record, for example, is presented. And there are many ways of slicing and dicing a track record, but often we find ourselves advising the GP about how to put this across so that it's clear for the LP. They need to clearly articulate the investment opportunity, but they also need to do it in a way that demonstrates their particular focus versus what, say, their competitors are doing. So it's a lot of work goes in at the start to really helping the GP bring this across. And then most GPs have been through some sort of journey themselves. There's something complex about them that needs to be articulated. So it could be that they're a spin out, or it could be that they have partners there that have come from various firms and they each have their individual track record, but perhaps they have a limited track record altogether. Or they've changed their strategy for one reason or another, or there's been a change of ownership, or whatever it may be, where these can be perceived as potential negative factors unless they're really addressed properly. So our job to begin with is just really to write this out carefully for the GP, such that the LP gets what the investment opportunity is that this GP is trying to present to the LP, gets all the nuance.
So you're the storyteller, if I put it that way.
Well, it's more to do with, I wouldn't go as far as saying writers, but it's, we're advisors to the authors maybe. There's, what we need is the raw material from them. And we spend a lot of time with our clients to really understand what makes them special. And these are things that the GPs may know and they're shouting about, or it may be more subtle things that they maybe take for granted, or because they don't know all the nuances of their competitors, they don't appreciate just how much of an edge they have in a particular area, say in origination. So we spend a lot of time to really try and bring that out. And then once we have all that raw material, then we will write it in a way that's clear for the LP, and also in a market standard way that an LP would expect to read it.
All right. So in this sense, you're talking about a track record and, polishing it up and showing it to the world and finding the edge. How do you go about that if you are a first-time manager, if you don't have that history, if you don't have that record, if you really have to present yourself to the market like the next best thing?
Well, if you have no track record, then it's difficult to do that, candidly. It's even with a track record, it's very, very difficult to raise capital. It's extremely competitive. But usually first-time managers have some sort of story behind them. It's unlikely that, your man off your street will suddenly just have an idea and go about raising money. What do they usually show? Usually the individuals there have worked at other organizations, either other private equity firms or doing direct deals for a family office or whatever it may be. And they have some sort of emerging track record to show. They may have just been fortunate and they've been working, deploying capital for one particular investor, which has given them some money to show the beginning of a track record, to start putting that money to work. And they've got something to talk about. It's not just about making deals and getting the returns back. It's also about showing LPs that you've been able to just manage third-party capital, and that you have happy LPs, that you've been shown that you've done the right thing on the governance side, on the reporting side, and so on and so forth. That you're able to just work as a manager of third-party capital.
So what is the usual LP is looking for in a manager, in a GP, in the team? What is the red flags that they can not see in the process, and what is the stuff that they do look for that really rings the bell?
Well, I think that it's a few things. Really, if it's a GP that's raising series of funds, it's already been in the market for many years before, and let's say is raising fund number 5, then the obvious place to start is simply to look at the performance of previous funds. Because when an investor is putting money to work with a manager, they want to make sure that the skill set that they have, the strategy that they've deployed, the returns that they've generated are repeatable for the next fund. So that's the easiest decision, where there's been no change. They satisfy themselves that the opportunity is still there today, that the team is still motivated, that the team are still working well together, that the manager is able to continue to manage the party capital and able to do business as usual, and therefore with a relatively high degree of certain, it knows that the next fund should perform well because the previous funds have done. But of course, life is not like that, and things get in the way, and usually that is exactly the challenge which GPs have, and where we work with them. GPs tend to appoint advisors when they have difficulty raising money, right? Not if they're raising money is easy, then they don't need support. But if you're a very established GP where you raised multiple funds in the past, you have an existing LP base, and all you've got to do is go to those same investors and say, can you re-up into the next fund? It's relatively more straightforward compared to a GP which either is raising money for the first time, or has had some sort of problem previously, like they've had a team departure, they've had to change their strategy for one reason or another, they've had changes in their LP base because LPs also just changes. Things happen there where they go out of business or they decide to stop investing, and therefore the GP needs to go out to find new investors to replace them. And these are more situations where we then get involved.
Okay, well, that's the first part of the process, right? You get involved, you write a story, you get all the preliminary documentation set. What's the next step? What's going on once you actually have your due diligence documents, you're filling out your data room, and you're ready to go?
Yeah, well, after that, you agree a list of investors that you'll introduce the GP to, and then you, in normal times, you start the road trips. And typically at Ely Place, we would cover the main institutions in Europe, and so therefore you start planning your marketing trips to wherever it may be, in the Nordics and Germany and Switzerland, France, and so on. And usually then we try and make it efficient for the GP, where they have a series of back-to-back meetings in each city. We accompany them because we tend to have personal relationships with the individuals they're meeting. We set the scene and let the GP do their work and pitch. And then at the end of that, we help wrap up, we confirm next steps, we go back, and then if a meeting's gone well, usually there's some sort of follow-up. You hope there is. It could just be that they go into the data room to start reading the material that we've prepared before. Or sometimes there are very specific queries that they have, and we just assist the GP in the follow-up with this. And then you gradually just look to move it forward until you hope to get a commitment to the fund by the LP at the end of it. But typically that process takes months, and would ordinarily involve multiple meetings between the LP and GP. They need to build a relationship. It's as much about a personal chemistry than anything else. So we help them achieve that, help them in any queries they have, and ultimately hope that, as I say, that they come into the fund.
Well, I imagine that this must be somehow awkward for a lot of the GPs, right? Because they're on the road, as you said, once every 3-4 years. They need to meet new people. They need to make the pitch, which usually somebody makes a pitch to them while they're investing. So is this something that you help them on, that you coach them on, that, you prepare the story, even what they deliver, what they present?
We help them with a presentation. We make sure it's clear. We go through it with them and so on. I mean, we're not a presentation training company. We draw the line there. We can help them with that. We have companies that we use, that we bring to our GP clients for them to rehearse and get feedback in terms of the style of their presenting. But that's not really our remit.
All right. Well, how does a placement agent get paid? And what sort of fees can a person expect out of the transaction?
So, typically speaking, we would charge a success fee for each investor that comes in, and depending on the work that's involved pre-launch of the fund, i.e., this documentation work I've explained, and how intensive we anticipate the work being in terms of how much we're going to be on the road and number of investors we're going to go to and so on, then often we would look to charge some sort of retainer as well. Because unfortunately the success fees, while they can be very profitable and meaningful, they are uncertain and they tend to be very back-ended. So a whole fundraising process could take a year, and then typically a GP will want to pay out the success fees in stages. So we can be waiting a very long time to get paid. So therefore, to keep the lights on, we we often have to ask for some sort of payment from the GP in advance.
Right, sounds like management fee and a carry in a way.
Similar, yeah.
Okay, what sort of range are we talking about industry-wide? If you're raising capital, how much does that cost?
Well, I think the market rate is you would typically charge 1 year's management fee.
Okay.
Typically, that's what the rate is. It varies, of course, but usually that's what GPs are fine with. And so therefore, for a private debt fund, the fees tend to be lower, but the fund sizes tend to be a bit bigger. So it sort of balances out. And then for private equity, the fees somewhat higher.
While we're talking about fees, you mentioned one very particular vehicle, which I'm curious about because you've been through that story many times. I mean, that is fund of funds. Can you explain how does that work, and why would somebody go through the trouble of double layer of fees, to get to the same investment that somebody may think that they can get easily directly?
Well. So it's not an industry that that I work in, obviously. But obviously we deal with investors who are funds of funds. I think the industry has really evolved. So you could understand the rationale, particularly the outset, where private equity may be a small part of an allocation for an investor, and it takes real expertise to go out and screen the market and find the right funds that offer the right risk, return, exposure, whatever it is that the investor is after. And so there are specialists there who do that. The way that the market has evolved is because private equity has become a much larger part of the allocations of institutions, that those institutions have there's been a trend of those institutions bringing that decision making in-house. And therefore relying on the fund of funds less. So in return, the fund of fund model has evolved to some doing either just accumulating more assets and just getting scale and charging a lower cost to get more clients, or moving to more of an advisory model, where it's ultimately the investors who are still making the decisions, but they're relying on some sort of advice on it, either in sourcing the funds or in doing due diligence on them. Others have moved to more focusing on co-investments. And then the other large part is the secondary market, which has grown enormously, as I mentioned at the outset. And many of those funds also do secondary transactions, which are often just too sophisticated for an investor to do themselves.
All right. You mentioned that you act as an advisor to the GP when they're fundraising. Are there instances where you act on behalf of the LP?
Occasionally, never really on the placement side. I think that we'd often informally sort of talk over an investment decision with an LP, but ultimately our advice goes to the GP. But on the secondary side, we perhaps would. So this is a situation where an LP wants to sell one or a portfolio of fund investments, and they want to run a process. They want to get the very best price. And so we can run a small auction process in order to get the best outcome for them. That's it at its most simplistic level. Often the portfolio is complex and needs to be divided up, and we need to opine on who are the different buyers for each part of it, because each buyer has a different focus. And often there are direct assets mixed in with that, and so on and so forth. So on the secondary side, it's possible, yes, that we could have an LP as a client.
All right. Well, let's go into more of a detail in terms of what you look at professionally. I mean, one of the books that you authored is about private debt, and I'm very curious about, you know, what is it so intriguing about that industry, because it has boomed in the recent years, as well as, you know, it has gotten substantially more sophisticated, you know. So can you explain what private debt is? What's the industry? Who are the players? I mean, it's very opaque to a layman, even to a person from the industry who does not deal with that segment.
Yeah, I mean, at its simplest level, I mean, it's very similar to private equity, but you're simply lending the money to companies rather than acquiring a stake in the companies. And to an extent, they're playing the role of the bank. It's just lending money, and it's no much more complex than that. The way that the industry has evolved is quite interesting. So in the US, these private debt funds are very, very established, have been the prime source of debt capital for private equity-backed companies for a very long time. In Europe, the pre-crisis, the market didn't exist in the same way because the banks were competitive, and typically the given deal that would be private debt financed in the US would be the equivalent would have bank financing here. What the financial crisis caused was the banks to de-risk and retrench from the market, leaving an opportunity for specialists to come in and fill that gap. And now it looks more similar to the US model. But what's interesting about it is that the risk return and the versatility of a private debt fund is quite different to a bank. And the debt packages that a private debt fund can put together is very bespoke and can be designed to really suit the need of the end company. I don't know if you want me to elaborate any more than that.
No, so would you say that, the more the regulation of the banking sector and, the more hoops that the bank needs to jump through in order to actually give a loan to a company, even though they might find them attractive, the more there is an opportunity for private lenders?
Yeah, I think the market has sort of found an equilibrium now. I mean, there's certain types of financing that is just better suited for the banking industry, and other types that are better for private debt players. Typically, a bank would lend senior capital. It needs it to be amortized, whereas a private debt lender can be just a bit more, perhaps take on a bit more risk, can have it doesn't have to be amortized, different arrangements in terms of cash yield and PIK, and it can be really tailored to allow, for example, a private equity-backed company to make an acquisition, so it's tailored around that, and it gets repaid at the exit of the company. So it's, I think more than it, I think it wasn't so much that the increased regulation necessarily caused it, but it's just it was more the catalyst, the financial crisis, and to an extent the regulation that came in afterwards is the catalyst that the industry needed just to get going. But I think, if you were to look at it, you would say that it just sort of, it was a no-brainer really that this industry should evolve in that way.
Yeah, I understand. So in terms of the evolution in the industry, I mean, where do you see the overall evolution going? Because we've seen a lot of trends on the market. Some of you have described. We've seen a rise on the venture side. Undoubtedly, we're seeing a lot of hype stuff such as crypto, and I'm very curious about how do you look at the market, because it's very turbulent in terms of new things popping out every day, and it's kind of hard to wrap your head around it.
You mean alternatives in general?
Alternatives in general, yeah.
Yeah, I mean, I think you'd say that in all sub-sectors you'd see continued growth. Obviously, some more than others. I mean, private equity now is a very established asset class, but you're seeing sub-sectors evolving all the time. On the private debt side, I think now that it's been quite established for some years, has reached sort of a point of maturity. The returns have come down, but at the same time, the sophistication has increased, and you're seeing a lot of subdivision of private debt in the same way as you've seen in private equity. So that could be sponsor-less backed lending. So a sponsor is the GP in a private equity deal, and there's certain lenders who lend money really to private equity managers to do their deals, and then there's sort of a safety cushion there, if you like, for the private debt manager, because that private equity player is really in the front seat, sort of driving the company. But then you have some who will lend to a company without there being a private equity player in. So that's the sponsor-less lending, and it's a very, very different strategy, very different risk approach. You have lending to technology businesses, companies that are not yet profitable. Again, just don't necessarily lend themselves to the sort of traditional parameters of how you would design a loan. Real estate debt and so on and so forth.
Right. You were mentioning the technology sector, and I'm curious about the money flows, because you're there with your fingers on the pulse of the market, and there's been a lot of talk about the venture sector, especially in Europe nowadays, and supposedly there is a lot of money looking towards Europe, looking towards unorthodox markets, whereas it has been before mainly focused on the US. Do you see that actually happening, or is that just news headlines?
Oh no, it has happened. It's I mean, the European technology market has really come into its own. And it's not just the backers. I mean, it's the companies. I mean, there's so many world-class technology companies in Europe that I think if you're serious about technology, you can't overlook Europe, and nor can you Asia. It's true that Europe for a long time was a bit unloved there, but no, there is some very, very successful technology VC funds now backing very exciting companies in Europe, for sure.
All right. Well, you're talking about these differences between US and Europe and Asia. What are the cultural differences? I mean, dealing with clients from different geographies. I mean, obviously, one must come across different approaches towards investments, towards looking at possible deals. Is the industry homogeneous in a way where everybody looks at the deals the same way, or do you actually see some differences?
Difficult to say. I think I don't think you need to go outside of Europe to find cultural differences. I think there are plenty within Europe, that's what makes it interesting, and that's what makes the opportunity, right? I mean, I don't think as someone who's expert in the mid-market in Germany could necessarily replicate the strategy in Italy, for example. The deal dynamics there are incredibly different, and it's only if you really understand that nuance does it work for you. And this just you see this across the board, but this is why these groups have these barriers to entry. That's why they have. They're able to ensure success because they get it, and it's not easily for competitors to replicate it. So so of course there are cultural nuances across the board. In terms of our experience, I mean, I think there's sophisticated institutions in invest across all geographies. So I would say that there are certain standards that LPs would require, irrespective of where they're based or where they're investing, and of course there are private equity associations and so on that look to set certain standards here.
All right. Well, so as I understand it, you're looking at a locality in terms of the money flows and expertise. As you would have a French GP backed by French LP, investing in French deals. Usually, that would be the case.
I think in certain markets, or maybe even in most geographies, there's a certain domestic bias of certain LPs that investors in general. They prefer to invest in something that they understand. So often the evolution of an LP is to begin investing in its home country and then move to a regional strategy and eventually further afield. And maybe they get expertise from outside their firm to help them as they grow. So there does tend to be an overweight with LPs within their home markets often, and where we often come in is an opportunity for us is to use the example of France. There may well be a French GP that has raised capital in France, that knows the French LPs very well, that so far is used to conversing solely in French, and the LPs understand the underlying companies they're investing in, and that's how they've done it. But now they need to raise money from outside of France, and they've just not gone about it. And it's and the way they want to go about that, might be different if they're presenting to, say, a Swedish pension fund compared to a French one. And this is where we come in, where we can help them with that transition, introduce them to new investors, make sure that the materials are presented in a way that Swedish investor would expect to see it, and assist them with that.
All right. Well, talking about expertise, I mean, let's go back to where we started in terms of the career. I mean, you mentioned, back in your 20s, you're ambitious, you're looking to burn the midnight oil, get a good training. I mean, what does it take to be a placement agent or a GP advisor? I mean, how do you get into the industry, and what sort of qualities are you looking for from your junior colleagues?
Well, there are very large established global agents now, a lot more than there were when I started off. And if it's an industry that someone is interested in, irrespective of their level, if they're fresh out of university or if they've got some years under their belt, there are companies that would interview them and if they're good enough, offer them a job. So it's now this become a much more established industry. There's, I think, a much clearer career path for someone who's young in their career. I think that I think it's really for the individual to work out what they want. I mean, what I like about the industry is the variety of it. That you're working with, in our case, a US credit manager, an Asian private equity fund, a German manager, a US, European private equity player. It's a real mixture, and generally working with very, very bright people who have managed to raise capital, get investors to back them, and have something unique about them. They're able to source deals and generate returns with investors. So there's never really a dull moment. So if you like that sort of variety, then then perhaps it's a job for you. I think you need to enjoy spending time with people. You just need to be able to build a rapport with investors. I mean, it's one thing just sending them a presentation, but that's not really how people work. And people like to build a relationship. They like to discuss these things. They like to do it sometimes over a social setting as opposed to just a meeting. So again, if that's in your personality to want to do that, then that probably is a plus. But also, I think actually it's quite an intellectual industry. If you really want to help sell a fund properly, you need to understand the subtleties of it. You need to get under the bonnet of what makes that GP special, and you need to take a close look at their deals, how they've structured them, what makes them unique, and you need to have a good understanding, I think, of finance for that. I think you need to be numerate, and only then, if you properly understand how a GP works, can you adequately explain it to an LP.
Right. So you're talking about continuous development, and that you keep learning. And I see how passionate you are about the industry, about the work. So the question begs: where do you see Ely Place Partners in, say, 5-10 years? What's ahead?
I honestly don't know. I think we're onto a good thing here. We're privileged that we have clients that investors want to back. It's for the reasons I outlined. It's an industry that I really like. We're growing very quickly. We have good visibility on revenue coming in. I'm sure we're going to be recruiting over the coming year. And I hope that in a few years' time, we'll be doing the same thing, really delivering for our clients, helping them raise money, helping them solve complex issues, but just doing it on probably a slightly bigger scale.
That's a very, very good point to actually wrap this up, because I think that from everybody around, we can wish you good luck with that, because you've been doing an amazing job, and for the 3 years that Ely Place has been going, it's been going strong. So more stronger years to come. Thank you very much for talking to me today, and have a great day then.
Yeah, pleasure, Mikhail. Thank you very much to you.
Thank you. Bye.